Okay, hello everyone. Thanks for joining us today. I just wanted to create a quick video here explaining what has been going on with our banking system the past few days and give a few thoughts on how we're thinking of what's happening in the news. So I'm Amanda Vaught. I'm here with David Vaught, our firm's CFA, Chartered Financial Analyst. Is that what an A is for? I always forget.
Yes, that's right.
Okay, so what do you want to give a brief background on what's been happening with our banks lately, David?
Well, a couple of them cracked under the stresses of I think it's pretty directly as a result of two things. The Fed action in raising interest rates quickly, which created an inverted yield curve, which made some of the reserve funds, some reserve bonds, treasury bonds of the reserve funds of banks, some of those lost value as interest rates went up. And then as banks needed to cash them in, they had to take those losses, and that created a flurry of losses in the bank income statements and a lack of confidence among depositors. So that was the nuts and bolts of what happened. But it's also a result of a few years ago in the prior administration, there was a lot of criticism of the Dodd-Frank regulations that were put into effect after the mortgage-backed crisis. And those were relaxed for banks between 50 billion and 250 billion. The stress test and other regulatory requirements, the bank said was too burdensome on those smaller banks. But these two major banks that failed are both right in that group. And so their regulation got relaxed, and now they've cracked under stress. This is not a good sign for the way we regulate banks in the Congress or by the Fed.
Right, and so I think it's important to point out that they're what are considered mid-sized banks.
Yes.
For larger banks, they have been doing these stress tests, that were regulated.
Yeah, Dodd-Frank still applies to them.
Right, and so I was on the JP Morgan call this morning, and they specifically mentioned that they have been doing those stress tests for things like this, these quick run on a bank that we saw happen with the Silicon Valley Bank, and also, what would happen to depositors' accounts in the event of a interest rate increase like one we've seen. So there is a difference here in the regulation between the mid-sized banks and the large banks.
There has been also a difference in the response of both the Treasury Department and the Fed tend to be involved in the FDIC tend to be involved in these bailouts, which have been done and announced over the weekend. And generally, they apply them to the banks that were considered too big to fail. That's the phrase you'll see quoted in the press. The big banks are too big to fail. And the reason they're too big to fail is they create contagion. A big bank fails, it affects lots of other financial institutions, lots of other businesses, and it ripples through the economy. So essentially what's in the bailout that's been arranged, which is really good for depositors. I'm not saying it's a bad thing. It is a good thing for them that they're going to get their money. They're going to get the money today. But it's an extension of the too big to fail doctrine, really, down into these mid-sized banks, which is unprecedented. Banks fail all the time, small banks especially, sometimes by the hundreds, sometimes in big industries. The ag sector in the 80s, 400 banks in the agricultural area went under, and nobody said, oh, the agricultural sector is unique and important to our economy, like was just said about the tech sector in the Silicon Valley Bank. Nobody was worried about that then. So this is new. It's a little unprecedented. And, we'll see if it's a good thing.
Right, because FDIC insurance typically covers deposits up to $250,000, and amounts over that are not insured. But in this instance, they cited the systemic risk, which means they're scared of this fear spreading. So that is a way to rationalize making the depositors whole beyond that $250,000, which is what the FDIC has said they're going to do for both Silicon Valley Bank and Signature Bank so far.
And those banks had most of their deposits over the limit. And that's very different than a small bank, that has a broad base of depositors. That's certainly true of these rural banks I just talked about that were affected in the farm crisis. In those cases, most of the depositors were already protected by FDIC insurance, whereas most of the depositors were small depositors. So in this borderline area, you know, you have a different kind of bank and a different kind of situation. And that's another reason I think the regulators and the Fed and the Treasury Secretary thought that they needed to expand and essentially make all the depositors whole here, which is a good thing for them and a good thing to prevent contagion, so that some of those depositors were needing that money to make payroll on the 15th of March. And so that those people that were going to miss a payroll, you know, if all these deposits were not covered, they're going to get paid, and that'll be a big help to the economy that doesn't have to take that extra shock.
Mm-hmm. But I would still say for our clients that if you do have amounts in a bank over $250,000, it is still not guaranteed that you would get that money back if you have a cash balance over $250,000.
That's true. Don't count on these kind of things that are bailout actions that are not provided in the law. We still hear criticism that Lehman Brothers was not bailed out in the mortgage-backed crisis, and other similar banks were. And so this is kind of dangerous territory for any governmental entity to have to deal in to favor one industry or one group over another. Sometimes they create precedents and sometimes they don't. So don't count on this being repeated, and be really careful about FDIC insurance. Mm-hmm. Which means you can use, you know, government bonds in brokerage accounts, and those are safe no matter what.
Yeah, that's where I was going to talk about next, is how this would impact you if you had a brokerage account at one of the large brokerage houses like Charles Schwab or Fidelity or elsewhere. That's covered under a slightly different insurance rubric than the FDIC.
Yeah, it sort of replicates the FDIC insurance. They're different entities, so it's not exactly the same. But there is a SIP, they call it SIPC insurance in brokerage accounts. But if you have safe investments, particularly in treasury securities or other very safe investments, you don't need that insurance coverage. The investment itself will remain secure. And of course, that also gives you a form of diversification. And generally now, because we have the inverted yield curve, it also gives you a higher rate of return than you can get in bank money market accounts.
Right. And I think one thing we're looking at going forward is we expect this to have the biggest impact on what the Fed does at their upcoming Fed meeting or for the remainder of the year. Do you want to
What was that phrase? You know, the Fed is going to raise rate till something cracks or something is hurt. Well, it just cracked. So, you know, they've raised rates very quickly. The rate at which they've been raising rates, I think has broken all the records. And one of the things that happens when the Fed changes the interest rate curve and changes interest rates, it affects the financial sector. And so here we've had a direct effect in the financial sector, in banks. And I don't think that's what the Fed intended. I think the Fed intended to have an effect on slowing down the economy by affecting the labor market, you know, and how many people are unemployed and how many raises they're getting and all that. That's been where most of the discussion has been. This is not something the Fed intended to start cracking or causing problems in the financial sector. So they're going to have to take a close look at that in their meeting next week and see whether they continue to raise interest rates now or as much or a different amount next week or a different amount in the future. No doubt they'll study that and we'll hear. But it also creates a controversy within the bank between the people who think there needed to be more financial regulation in the first place. There was controversy in the reappointment of Chair Powell because some of the alternative appointments were considered stronger on financial regulation than he is. So some of that talk is going to come back up again too. And how they react to that, we'll see.
Right. I think we've seen the expectations for the Fed interest rate hikes go from between 1 and 1.25% last week to now the expectation is 0.25% for the whole year. That is what the bond market has now priced in. So that's just a huge swing. If you've kept an eye on the bond market, you can see that reflected in the values of their bonds and of the interest rates you can expect to get.
Yeah, those are market expectations. They really, they really are determined by, real money being invested in the market and how they affect the yield curve. So the bond market can affect interest rates too, not just the Fed, and how the investors invest their money. And so what you're referring to is a change in how the investors view it. Now we get to see next week how the Fed views it. Sometimes they're, not on the same page.
Right. But I think we are going to expect to see some of those up and down swings continue as this unfolds.
More volatility.
Yes.
Yeah.
So
we're in a period of volatility, and some people that are just used to watching the stock market don't fully consider how big the bond market is. The bond market's bigger than the stock market in general in the world. And so how interest rates move very often tells you something in the longer term sense about how stocks are going to be affected, because stocks tend to price future earnings, and future earnings, how you price those is dependent on the underlying interest rate that you use to do that projection. So this volatility is these changes in the economy and changes in the Fed and the interest rate market are going to continue to work their way through.
Right. Well said. And I think that what we're talking about right now can have a large impact on what happens in the bond market or the stock market in the short term. But always the moral of the story is to keep your eye on the long term. All of these risks are always out there that can cause these ups and downs. But if we take a step back, look forward, okay, if the Fed is not going to raise rates as much as we thought they were, that is good for stocks over the long term. Stocks would be able to go up more, and potentially a bond market as well. I don't want to sound like I'm predicting the future, but I'm just trying to say we want to take this longer term view instead of focus.
Well, that's a good point for investors, Amanda. The one I would add to it is if you're an investor and you're taking risk, which you have to do to get return, then be prepared for things you don't expect. Things are going to happen that you don't expect, and sometimes that causes you a lot of concern. But generally, if you've been prepared and you're well diversified, you're able to handle that, and the short-term variations are not as important as the long-term results.
Right. And I would just urge any of our clients, if you have any questions on how this could impact you, your portfolio, or your banks that you use, please reach out. We're available to help walk you through this.
I always like to say, Amanda, we know what a bond is. We don't just look at the stock market. We also look at the bond market, and we know that that's an important part of clients arranging their portfolios to have enough safety to keep them asleep at night.
Yeah. Okay. Anything else you think it's important for?
No, I mean, I think this volatility just keeps coming, and due to different events, and this is another one of those. So, fasten your seatbelt and don't let it upset your stomach.
Okay. Sounds good. Have a good one.
Okay, thank you.